It's Mike Sabatino, the Certified Financial Planner from McGraw-Hill's Financial Wellness Program. Good morning, everyone. It's great to see so many of you on a 9 o'clock webinar. Awesome. I'm really excited to be with you today and talk about why a Roth IRA is right for you. This is a topic that we're getting a lot of questions on heading into the tax deadline on April 17th. So we thought that it would be a great opportunity to do a quick webinar on the topic about Roth IRAs. So Matt, you want to flip the slide? So this quote is attributed to Albert Einstein. Everything should be made as simple as possible, but not simpler. And this quote, more than I think any other I've read, really guides everything that we do in the financial wellness program. We're always thinking about whatever topic we're addressing, about making it as simple as possible for you to take action, to make it as simple as possible for you to pay down debt, to build savings. Today's webinar is for people that are clueless about Roth IRAs and want a simple explanation about what they are, how you can benefit from them, and more importantly, a quick and easy way to get started saving tax-free. We're not going to get into the nuances of the IRS tax code. We're not going to get into intricate investment strategies. If you want to talk about that stuff, I'm happy to do it one-on-one. There's a lot of great free YouTube videos out there. But today it's all about making Roth IRAs as simple as possible, but not simpler. So a little background on me, guys. I'm a certified financial planner. You often hear that as CFP for short. This is the gold standard financial planning credential in the United States. And I'm an employee of McGraw-Hill Federal Credit Union. Your company, McGraw-Hill Education, engaged the credit union to be the exclusive provider of financial wellness benefits to all employees, all U.S. employees at MHE. The credit union, for those of you who don't know, we've been around for 80 years. We're a financial cooperative, meaning that we exist simply to serve our members. It's a great place to do your banking. If you're not a member, highly recommend you become a member. It doesn't cost anything, and it's part of your benefits. Now, my mission as a certified financial planner in the workplace is to help you guys break down large goals into more bite-sized goals that, more importantly, can be set, monitored, and tracked. Again, coming back to simplicity. Think of it like, it's very similar to the concept of health wellness. If you guys, any of you on the call have ever done like a health wellness challenge, same kind of concept as the 10-step a day approach to wellness, right? We take things one step at a time, we break them down, and we make them simple and easy. So everyone, all I can really say for sure, I see a lot of familiar names on this call, which is awesome, and I see a lot of new names which I haven't talked to you guys yet, and that's really exciting for me. All I can say is that everyone on this call has a unique situation financially. And I want to respect that, and I want to understand a little bit about the makeup of the audience today. So we're going to put up a few quick poll questions. So let's go to the polls right now. First question I have for you guys is, if you were given $10,000 tax-free right now, and you had the ability to invest all of it in one of the following options, which would it be? Would you pay down student loans or credit cards, save up for a home down payment, open a college savings plan, stash the money in an emergency fund, or use it to build wealth in retirement accounts? So if you were given $10,000 tax-free, make sure you click the radio button and the submit button. So let's see what we've got. I'm just waiting for the polls to tally. Okay, so 7 of you said you'd pay down student loans or credit cards. 4 would set up a home, would save up for a home down payment. We've got 2 that would open a college savings plan, and 3 of you would stash it in an emergency fund, and 10 would build wealth in a retirement account. So we've got a nice mix of answers here. And we're going to talk about how Roth IRAs are flexible and can be used in a lot of these different situations. Let's go up to the next poll question. All right, which best describes you? A millennial, age 23 to 34, Gen X, age 35 to 54, boomer 55 plus. Make sure that you hit the submit button at the bottom right to record your answer, okay, or else it won't record. So we'll let that, we got a few more seconds on the poll, and then we'll take a look at the results. All right, the polling has ended. We'll see the results pop up in a moment. Okay, so 12 of you are millennial, age 23 to 34. 21 of you are Gen X, so 35 to 54. 8 of you are boomers, 55 plus. Great. So the biggest category here is Gen X with 21 folks, and then we still have a good representation of millennial and boomers. And so we're going to talk about how each one of these age demographics can benefit from a Roth IRA. They're typically, Roth, people tend to think of them as for young folks, but they can be used for all different ages, and we'll talk more about that. Now let's go to the last poll question. How are you currently contributing to your McGraw-Hill 401k? I'm making regular pre-tax contributions. I'm making Roth 401k contributions. I'm making both pre-tax and Roth contributions. Again, click the radio button, then click submit in the bottom right corner to register your answer. How are you currently contributing to the McGraw-Hill 401k plan? Interesting. Okay. 38 of the 47 people are making pre-tax contributions. None of you are making Roth 401k contributions, and 3 of you are making both. Great. All right. That's really, really helpful. And so we'll talk a little bit about, many people don't even realize that you have a Roth 401k option. And so if you want to learn more about that, we're going to talk about that. So, all right. Great. I appreciate your patience with the poll questions. I feel like I have a much better understanding of where you guys are coming from. All right. So this is the day of Einstein quotes. So Einstein supposedly also said that compound interest is the most powerful force in the universe. So when all is said and done, guys, the key to building wealth for most employees is just consistently saving small amounts over long periods of time and literally let the force of compound interest do its magic. Compound interest, all that means is you're earning interest on interest rather than keeping it in a savings account and earning nothing. So Roth IRAs are the most tax-efficient vehicle to build wealth because your money compounds tax-free. So here's an example of what I'm talking about. So let's say that one of you, 21 Gen X, who's on the call today, one of you says, all right, this guy, Mike, says, it seems to make a lot of sense here. I'm going to open up a Roth IRA today, and I am going to simply auto deposit $230 a month for 30 years into this Roth IRA. Essentially, you're going to be maxing out the Roth IRA each year. And if you just did that, $230 a month for 30 years, and you earned a reasonable 7% return, you're going to end up with close to $300,000 at age 65, tax-free. I'll say that again, $300,000 tax-free. Compare that to, and that's the red line on this chart. The blue line is if you just simply put $230 a month into a savings account earning close to nothing. Look at the gap there. It's over $200,000. This is what Einstein talked about with the most powerful force in the universe being compound interest. This is not rocket science. Anyone can do this. All you have to do is set up a Roth account with direct deposit, and you're there. And it takes less than 5 minutes, which we'll show you. So the reason I love Roth and the reason I think they make sense for just about everyone on this call is that Roth IRAs are flexible. Your McGraw-Hill 401k or any 401k is not flexible. What do I mean by flexible? The single biggest reason to open a Roth IRA is the flexibility it gives you to use the money for a bunch of different future goals. In other words, it can serve as a dual account for both retirement, but also other goals, which we'll look at in a moment, such as saving for college or preparing for home ownership, or as simply a quasi-emergency fund. We're going to take a look at these examples in a moment, but one of the key themes you're going to hear from me for the next 15 minutes is flexibility. That's what Roth IRAs are all about. And corporate 401k plans are great, especially yours because of the generous match, but they're simply not flexible. And we know how important liquidity is to employees when managing their finances. Now, Roth IRAs are also, they're liquid. Your 401k isn't liquid. We know why, so the reason this is important, we know from the money coaching program that the McGraw-Hill Money Coaching Program, that over 80% of McGraw-Hill education employees live paycheck to paycheck. This cuts across income categories, it cuts across age groups. Life is complicated. There are real expenses now, and sometimes there are emergencies. Everyone I know, all 47 of you on this call, want to save for retirement. But most employees, at least that I talk to, have very little, if any, emergency reserves in case of things such as a job loss or a surprise medical bill. So unfortunately, what happens is when an emergency hits, many employees are forced to take a 401k loan or a hardship withdrawal from their McGraw-Hill 401k. The reason we love Roth IRAs is that they have all the tax benefits of a 401k, but they're more liquid in case of an emergency. You can actually, believe it or not, you can withdraw your Roth IRA contributions tax and penalty free at any time for any reason. I'll say that again. You can withdraw your contributions from a Roth IRA tax and penalty free at any time for any reason. That's a huge bonus there. So in an ideal world, look, in an ideal world, it would be great if your entire emergency fund was sitting in a savings account in cash. But our money lives are complex. There's a lot of competing demands. And Roth IRAs, again, they give you flexibility to both save for retirement and then hedge yourself in the short term as sort of an insurance policy if you need the cash for an emergency. You simply can't do that with a 401k. So I'm not adverse to employees dipping into their Roth IRA in case of a true emergency. Now I'm talking about a true emergency. I'm not talking about, concert tickets or, a last minute vacation to the Caribbean for true emergencies. So I'm going to give you guys a warning here right now. The next two slides have some real boring tax stuff on them. Stick with me for like the next 3 minutes. We'll get through this. It's not that bad. We can't, unfortunately, talk about Roth without understanding a few key concepts related to the tax thing. So let's just jump into this real quick. I tried to make this as quick and painless as possible. So I get a lot of questions from employees about the difference between the pre-tax and the Roth option in your McGraw-Hill 401k. So here it is in a nutshell. On the left, you have pre-tax. On the right, you have Roth. Now, we know from the poll question that all of you, except for 3, are contributing 100% pre-tax to the 401k. So that means you're getting a tax break up front on the contribution. So in other words, it lowers your income as soon as you make the contribution. That money is invested. It grows tax deferred. But when you take it out at retirement, it's ordinary income. You're going to pay ordinary income taxes on that balance. So a lot of employees forget this, that when you look at your balance in the Wells Fargo 401k, that's not all your money. As much of a quarter of it, Uncle Sam has a claim on. And that's a really important thing to understand. So on the right is the Roth 401k option. So the biggest difference, it's just think of it like the mirror opposite of pre-tax. So instead of getting a tax break up front, you're putting in after-tax contributions. You don't get any income tax break on the front end with the Roth 401k. The money does grow tax-free, though. Once it goes in, it grows tax-free. The distributions are tax-free. As long as the account is open for at least 5 years and you are 59 and a half or older when you start taking withdrawals. You don't have to write this stuff down. We're going to send you the slides. There are a couple of unique circumstances where you can pull out the money, especially for a down payment on a house, tax-free, and for college education expenses before 59 and a half. But essentially, the Roth option in your 401k is, about 60% of 401ks in the United States now offer this option. If you're not using it, don't worry, because no one else in the country is using it either, because I think a lot of folks are confused. In fact, only 13% of people that have access to 401ks are using the Roth option. And I believe it's simply because there's not enough education going on around how to use them. So in a nutshell, the question I get all the time is, okay, so who exactly would I benefit from contributing, from switching my pre-tax contribution to a Roth? And the answer to that is it depends. So if you expect your tax rate to rise in retirement, the Roth is a better option. Even if you expect your tax rate to remain the same, the Roth is a better option. Now, for most of the last 20 years since Roth IRAs have been around, it's usually been thought of as a tool for young people, right? Because they're new to the workforce, their income is low. It's fairly safe to say that their tax rate's going to rise later in their career. But here's the interesting twist this year is because of the new tax law, tax rates have gone down. So it's even more attractive than ever to look at the Roth option, and not just young folks, but everyone on this call. Keep in mind, these tax rates are going to sunset in 2026. And if you look at the deficit, my bet is tax rates are probably not going to go lower over the next 10 to 20 years, which is why this topic is so important and so timely. Now, the next slide here is Roth 401k versus Roth IRA. What's the difference? So this is a quick down and dirty cheat sheet. In the left column is the Roth 401k, and the right is Roth IRA. So let's just quickly tick through these. There are one really big benefit of the Roth 401k is that there are no income restrictions. So if you make a lot of money, Roth 401k is likely to be a better bet for you than opening up a Roth IRA, because there are income restrictions. For example, if you're a married couple that makes over 200 grand, you can't put money in a Roth IRA. So high income earners, Roth 401k makes a lot of sense. The other benefit of the Roth 401k is you can put more money in it than a Roth IRA. You can put up to $18,500 in the Roth 401k. And this is a question I get all the time. Do I get $18,500 for Roth 401k and Roth pre-tax? No, you just get one $18,500 between both pre-tax and Roth options. With a Roth IRA, if you're under 50, you can only put $5,500 in there. If you're over 50, you can put in an extra $1,000, $6,500 total. Catch-up contributions in the Roth 401k, if you're over 50, you can put an extra $6,000 in. With a Roth IRA, you can put $1,000 in. The employer match, look, you got a great match at McGraw-Hill. Before you even consider Roth IRAs, hands down, make sure you're putting 6% in the McGraw-Hill 401k, because free money is better than tax-free money any day. So you have the employer match in the 401k. You don't get that in the Roth IRA. The next two are really, I think, some really important benefits of the Roth IRA. The one is that a lot of retirees get surprised by what are called required minimum distributions in retirement. So once you turn 70, the government starts making you take money out of IRAs and 401ks. There's a formula based on your age. There are no required minimum distribution requirements with a Roth IRA. That's huge. The other thing which we've talked about in the liquidity slide is that Roth IRAs are liquid, your 401k isn't. And again, through our coaching, we know how important liquidity is to a lot of folks. So let's move on. The flexibility of a Roth IRA compared to a 401k, it really does open up some very interesting planning possibilities. In addition to just saving for retirement, it opens up some more options. And there are some interesting options for, if you're a millennial, Gen X, or boomer on the call. I just want to quickly run through three of them very briefly. If you want to talk more about them, we'll give you a chance to schedule one-on-one with me. But we're going to look at three examples. For the millennials, the Roth can serve as an emergency fund in addition to saving for a home down payment. With Gen Xers on the call, it's an interesting vehicle to save for college, in addition to building wealth for retirement. For boomers that are maybe considering a next act or a transition out of corporate America, it's a great tool to build a bridge to your next act. And also, it's a great tool for what I call tax insurance. I'll explain what tax insurance is in a moment. So let's just start with the millennials.
Hey, Mike.
Yeah.
Hey, just a quick question. Could you explain more about the catch-up contribution and how folks can take advantage of that?
Absolutely. So if you're Over 50 years old, guys, you can contribute. $24,500 to the McGraw-Hill 401k. You can divide that up any way you want, pre-tax, Roth, all pre-tax, but the IRS basically gives you an extra $6,000 if you're over 50. So the other, in the Roth IRA, again, if you're under 50, you get $5,500. You get a $1,000 catch-up contribution if you're over 50. Is that good? So let's talk about millennials preparing for home ownership. Here's an interesting opportunity here for you. So you can withdraw, as I've said, 100% of your contributions and up to $10,000 of investment earnings from a Roth IRA with no tax or penalty if you're buying your first home. The only stipulation is that you have the account open for 5 years and that the withdrawal is for your very first home. So going back to the miracle of compound interest, we use the same calculator here, and we said, okay, what if today a Gen X couple put in $11,000 per year for 5 years? Where did I come up with $11,000? It's $5,500 for each spouse. So you put in $11,000 for 5 years, and this money, let's just say, grows at 7%. You're going to come out with close to $50,000 after 5 years that can go tax-free toward a down payment. This is, and again, like if let's say you decide you don't want to, you're going to delay buying the home, or you're going to end up renting, or you just don't know what you're going to do, that money just still stays in the Roth. You can use it for retirement. Again, the flexibility feature. Now, saving for college, I talk to so many Gen Xers that, life is it's so complex when you have kids, right? There's so many competing expenses. I'm 47. I'm a Gen Xer. I got an 8-year-old and a 10-year-old. I know what it's like. It's like you have your best intentions of saving for college, but most of us just never get around to it because we have so many other things we have to deal with. There's something called a college savings plan, a 529. Yeah, they are great. The problem is most employees never open them up and they never fund them. So I think the key here is, what if we introduced some flexibility and made it easier for folks through a Roth IRA? That could kind of cut through the inertia and help people with the college saving puzzle. So how this works is, again, the same calculator. What I did here is I put that same, let's say you're a Gen Xer on the call, you have a 8-year-old child. All right, so they're going to go to college in 10 years. You haven't done anything yet. You said, you know what, let's open up a Roth. We're going to put in $11,000 per year. Again, $5,500 per spouse. We're going to grow that at 7%, and boom, you have close to $100,000 saved by the time your child is 18. Now, when that comes, maybe they're going to go to a state school and it's a lot cheaper. Well, you don't have to use the money. You just let it compound in the Roth for retirement. Maybe they don't go to school. You can do whatever you want with that money. So that's, again, the flexibility. And the other thing that's really interesting here as a college savings vehicle is that Roth money, because it's in a retirement account, it's not counted toward what's called the estimated family contribution. So what this means is that if it's in a Roth, you're likely to get more generous financial aid than if it's in a 529 plan. Money in a 529 plan is penalized somewhat when it comes to financial aid calculations, not so with the Roth. One caveat here, guys, is that where the 529 does make more sense than a Roth is that some states do offer a state tax deduction for 529 plans. And they happen, three of them, which I know are important to the people on this call. If you live in New York, Iowa, or Ohio, you do get a state tax deduction for a 529 plan. And so in those cases, if you live in New York, Iowa, or Ohio on this call, the 529 probably makes more sense. Again, if you want to talk more about this strategy and break it down, the specifics for you, let's just set up a one-on-one and talk about it, okay? And I'll show you how to do that in a moment. Now, last but not least, for the boomers on the call, the Roth, I look at it as a tax diversification strategy. For boomers, maximizing Social Security and figuring out a way to work longer are the two most important levers for retirement security. Minimizing taxes is a distant third, but it's still very important. So again, I want to come back to this concept. When you look at your Wells Fargo balance, keep in mind that if you're contributing 100% pre-tax, the IRS effectively could have like a 25% claim on that balance, because when it comes out, it's going to be taxed. So for boomers on the call, now is a great time to start building a tax-free bucket so that you have both and you're diversified. And then I just want to sort of finish up here. We talked about in the beginning, our mission is to make saving as simple as possible, make it easy for you. Our digital investment management services make it extremely easy for MHE employees to begin investing in a Roth, even if you're on a shoestring budget. We've partnered with a company called Betterment. It's the first digital investment platform in the world. It came out about 10 years ago, and every McGraw-Hill employee has access to a dedicated certified financial planner to help them make progress on their goals. And we are fiduciaries, which means that we must put McGraw-Hill Education employees' interest above our own. And so my role as a CFP and a financial coach is to show you how to break down these long-term goals into manageable bite-sized goals, and we help you do that. This is a screenshot of literally, we can help you open a Roth in less than 5 minutes. What happens is I literally pre-fill a digital form with your information. You get an email from me, you plug in your Social Security number, and then this screen shows we just link wherever you do your checking or savings. We make a digital transfer to fund the Roth, and boom, you're done. It's as simple as that. This technology simply didn't exist 5 years ago. And so now there's no paperwork, there's no hassles at all. And you get to work with an experienced, certified financial planner that's a fiduciary. And then this is just, once you set up the account, we do a meeting to set the allocation for the money that you put in the Roth. And ideally, we would make that allocation very similar to the allocation in your McGraw-Hill 401k. We use low-cost Vanguard index funds, so the fees are very, very, very low in these accounts. So I'm just going to wrap up. You know, the future depends on what you do in the present. This is attributed to Gandhi. The future depends on what you do in the present. What we're doing in the present right now with a bunch of McGraw-Hill employees is that they are, you have this interesting window here before April 17th, where you can open a Roth IRA, put in $5,500 if you're single. You can put up to $11,000 if you're married, and that goes towards 2017. And then you can begin to just set up an auto deposit of $230 a month to fully fund the Roth IRA for 2018. So you have another 7 days. I've set aside office hours to talk one-on-one with you guys and help you set this up and make this happen. The next step here is you're going to receive an email from us, and when you click on that link, it's going to say open a Roth IRA to get started. And you're just going to click on that first option, open a Roth IRA, schedule a time that's convenient for you guys. And so I don't hesitate, guys. Just do it now. You're going to get the email. Book now. I've got plenty of appointments available, and I really look forward to helping you begin to save long